Final accounts of companies. In this section, we try to understand about the legal listing of the final accounts of a company under Companies Act 1956. Need for legal requirement. Final accounts of a limited company consists of profit and loss account and balance sheet. Preparation of final accounts by a company that is limited is made compulsory under law. Under Section 209, it is compulsory for the company to keep certain book of accounts. Companies Act provides the form of balance sheet according to Part 1 of Schedule 6 of Section 211. Under Companies Act 1956, Section 211, Schedule 6, Part 1 gives a format for preparation of balance sheet, and Section 211, Schedule 6, Part 2 gives requirements for preparation of profit and loss account for the company. Companies Act provides the form of balance sheet under Part 1 of Schedule 6 of Section 211. In the same section, it is required that balance sheet and profit and loss account of the company should exhibit a true and fair view of the affairs and profit and loss of a company. Trading account need not be separately prepared but can be included in profit and loss account. Next is legal requirement for profit and loss. There are 4 groups of guidelines to prepare profit and loss account in Part 2 of Schedule 6 under Section 211 of Indian Companies Act 1956 and are general, income, expenditure and other quantitative information. For preparation of profit and loss account of a company, it should clearly disclose the results of activities of the company. Every material information of the company should be disclosed. The corresponding figures of the previous year for all items also need to be disclosed. As per the general instruction for preparation of profit and loss account, the guidelines followed are: 1. It should clearly disclose provision for tax and profit after tax before taxation. It should clearly disclose all the appropriations made out of profits and the surplus carried forward to the next year. And any change in the accounting system should be clearly disclosed and its effect on the profit and loss of the company. As per the instruction on income for preparing profit and loss account of a company, the following guidelines exist. Namely, 1. It should disclose sales in respect of each class of goods in which company deals as well as aggregate amount of sales. 2. Income derived from trade and other investments. And 3. In case of company that provides services, the gross income derived from rendering services need be disclosed. As per the instructions on expenditure for profit and loss account of a company, the guidelines exist and are: 1. Item-wise breakup of raw materials. 2. Closing stock of finished goods. And 3. Opening and closing value of work in progress. Also, remuneration paid to managing directors need be disclosed along with commission paid to directors and agents as well as any discount felt on brokerage. Next, we'll take a look at share capital. Share capital is the amount of funding that a company raises by selling its stock to the public. Authorized share capital serves the number of shares that a company can issue based on whatever is mentioned in the Article of Association. Issued share capital is the cumulative monetary value of shares that are offered to investors by the company. Subscribed shares are shares that the investors have promised to buy. Called up share capital is the number of shares that the shareholders owe but not yet paid at the time of issue of shares. Equity shares are amount paid by a company's owners or shareholders, and preference shareholders receive a dividend before common stock dividends declared by the company. Preference shareholders also enjoys a preferential right to receive money in the event a company is getting wound up. Share capital of a company is required to show the following items under share capital and are: authorized shares, issued shares, subscribed shares, and called up shares. Also show unpaid calls which are to be lessened and adding of paid up capital and forfeited shares. which are shares whose application money remains unpaid by the subscriber and board of directors according to the article of association of company, forfeits the shares. With regard to share capital, the company should state the following facts, including details of authorized, issued, subscribed, called up, and paid up capitals, details of number of shares and shares face value, amount called upon each share, classes of shares, both preference and equity, shares issued as bonus shares, as well as shares allotted as fully paid for consideration other than cash. According to Section 77 of the Companies Act, a company limited by shares and a company limited by guarantee cannot buy back its shares unless reduction of capital is effective and sanctioned according to the Act. But Companies Amendment Act introduced in 1999 under Section 77A, 77AA and 77B has allowed buyback of its own shares by the company subject to conditions that it should be authorized by Article of Association among many other conditions. SEBI requires that the company going in for a buyback should deposit in escrow account, which is a special type of account with a specified duty. Once duty is performed, the account is no more. In present case, till the buyback of shares are paid to the shareholders. Hence, the escrow account in case of a buyback may consist of cash deposited in a scheduled commercial bank, bank guarantee in favor of merchant banker who handles the buyback of shares, and deposits of acceptable and appropriate securities and margin with the banker. Next, we'll take a look at reserves and surplus. Reserves and surplus remain as capital employed in business and are amounts that are set aside from profit, which are not supposed to meet any liability or contingency or diminution in value of assets from the date of balance sheet. Reserves and surplus are rearranged under the liability side of the balance sheet and follows the following order as given. Capital reserve. Capital reserve is any reserve that cannot be distributed to a company's shareholders. Examples may be an appreciation in the value of an asset, redemption of debenture at a discount, credit balance in the forfeited shares account, profit prior to incorporation, etc. Next is capital redemption reserve, share premium account, other reserves, surplus, proposed additions to reserve, sinking funds. So these are reserves and capitals that get rearranged under the liability side of balance sheet, and that is what we have explained. Next, we'll take a look at secured and unsecured loans. Secured loans are debentures, loans and advances from banks, loans and advances from subsidiaries and other loans. Unsecured loans are in the case of banking companies, fixed deposits, loans and advances from subsidiaries, short-term loans and advances. Unsecured loans are arranged in the liability side of the balance sheet in the following form: likely fixed deposits, loans and advances from subsidiaries, short-term loans and advances, and other loans from banks and from others. Next, we'll take a look at current assets, loans and advances. Current assets are shown as under current assets, loans and advances in the balance sheet, and it is listed as 1. Interest accrued on investments, 2. Stores and spare parts, 3. Loose tools in stores, stock in trade, which is stocks purchased in business for resale purposes, sundry debtors, who is a person who receives goods or services from business in credit and is liable to pay the business in future, cash in hand, bank balances with scheduled banks and with others. Next, we'll take a look at what is current liabilities and provisions. Current liabilities are shown under current liabilities and provisions in the balance sheet as shown under 1. Acceptances, which are agreements by an importer to pay seller of goods by a specific date. 2. Sundry creditors, who is a person who gives goods or services to business in credit and is liable to get paid by the business in future. 3. Subsidiary companies, which is a company that is more than 50% owned by an investment of a company and denoted as an asset in the parent company's balance sheet. Advance payments are unexpired discounts. 5, it is unclaimed dividends. 6, it is other liabilities, if any. And 7, interest accrued and not due on loans. Next, we'll take a look at contingent liabilities. A contingent liability is a liability which may or may not arise. It is a possible debt in the future, which is the result of a past action or of a future set. Examples are guarantees given for debt owned by others, partly paid shares held in other companies, etc. More examples of contingent liabilities include arrears of fixed cumulative dividends, etc. Next, we'll take a look at what is in fixed assets. Before fixed assets, we'll also take a look at what is investments. The following points must be clearly stated with respect to investments, namely nature of investments, mode of valuation, whether cost or market value, and classification of investments. In the balance sheet, investments are to be shown as investments in government or trust securities, investments in shares, debentures, investments in immovable properties, investments in capital of partnership firms, and balance of unutilized money raised by issues. Now we take a look at what is fixed assets. Fixed assets are capital assets held on a long-term basis and is heavily made use of in operation of a business, normally not purchased with an intention to resell. Fixed assets have a life expectancy of more than 1 year. Examples of fixed assets are land and buildings, plant and machinery, fixtures and furnitures, etc. Fixed assets must be classified and distinguished. The following details of fixed assets must be shown in the balance sheet, namely cost, which is the original cost, any additions to fixed assets made in an year, deductions made, if any, total depreciation that is written off of fixed assets each year. Fixed assets may be rearranged in the following sequence in the balance sheet, which is 1. Goodwill, 2. Lands, 3. Buildings, 4. Leaseholds, 5. Railway sidings, 6. Plant and machinery, 7. Furniture and fixtures, 8. Development of property, 9. Patents and trademark, 10. Livestock, 11. Vehicles, etc. And lastly, we'll come to balance sheet as part of legal requirement while discussing final accounts of companies. So what is a balance sheet? A balance sheet of a limited company can be prepared either horizontally or vertically. It normally has 6 columns, 3 columns each for liabilities and 3 columns for assets. As per Schedule 6 of Part 1, assets are taken below liabilities. The liabilities of balance sheet are arranged as follows, namely share capital, reserves and surplus, secured loans, unsecured loans, current liabilities and provisions. So under current liabilities and provisions, current liabilities, provisions and other provisions exist. The asset side of the balance sheet shows the sequence, which is shown as fixed assets, investments, current assets, loans and advances, miscellaneous expenditure, and profit and loss account if there is any debit balance. This sum up the discussions on final accounts of companies. Thank you.